3 weeks ago, South Korea's economy did something it hasn't done in 25 years. And if you're not paying attention, you're about to miss the warning sign that predicted the last 3 global recessions. Look, I know South Korea doesn't dominate headlines like China or the US, but here's what most people don't understand. South Korea isn't just another economy. It's the world's early warning system. When South Korean exports drop, it means global demand is collapsing. When their chip manufacturers cut production, it means the entire tech supply chain is about to seize up. When their one currency starts sliding, it means international investors are running for the exits. And right now, in early 2026, every single one of those indicators is flashing red. So in the next 10 minutes, I'm going to show you exactly what's happening in South Korea, why it matters way more than you think, and most importantly, what this means for your job, your investments, and the global economy over the next 12 months. Because if history repeats itself, and it usually does, we're looking at the first domino in a chain reaction that could reshape the world economy. Here's what makes South Korea special. It's not the size of their economy, though at $7 trillion, they're the 10th largest in the world. It's what they produce and who they sell to. South Korea is the world's leading manufacturer of memory chips, display panels, and smartphones. Samsung alone controls 40% of the global memory chip market. SK Hynix is the second largest. Together, they're in virtually every electronic device you own. They're also the world's largest shipbuilder, building 45% of all commercial vessels. A major auto exporter with Hyundai and Kia. A steel powerhouse. A petrochemical giant. But here's the critical part. South Korea imports raw materials, adds high tech value, and exports finished products to everyone. China, the US, Europe, Southeast Asia, everywhere. This makes them the ultimate economic sensor. When global demand weakens, South Korea's export orders drop first, usually 3 to 6 months before it shows up in bigger economies. When a recession is coming, South Korea's numbers start falling before almost anyone else's. They were the canary in the coal mine before the 1997 Asian financial crisis, before the 2008 global financial meltdown, before the 2015 global growth scare, and they're flashing warning signs right now. In December 2025, South Korea's exports fell 7.8% year-over-year. Their manufacturing index dropped to the lowest level since 2020. Business confidence levels not seen since the pandemic. Then in January 2026, things got worse. Their central bank made an emergency rate cut, their first in nearly 2 years. The won fell to its weakest level against the dollar since 2009, and their finance minister held a press conference using the word crisis 4 times in 10 minutes. If you know what to look for, this is screaming that something big is coming. Let me break down the 5 specific indicators that have economists terrified. Signal 1, chip exports collapsing. Semiconductor exports from South Korea dropped 11.4% in the fourth quarter of 2025. This is huge because chips are in everything. Cars, phones, computers, AI servers, industrial equipment, everything. When chip orders fall, it means companies worldwide are cutting production plans. Apple isn't ordering as many chips because iPhone demand is weak. Auto manufacturers are scaling back because car sales are slowing. Data centers are postponing expansion because business investment is dropping. The chip cycle doesn't lie. It's pure demand signal. Signal 2, China exposure. China is South Korea's largest trading partner, absorbing about 25% of all Korean exports. And China's economy is struggling badly. Their property sector is still in crisis. Consumer spending is way down, employment is at record highs. In 2025, South Korea's exports to China fell 14.2%. That's not a dip, that's a collapse. Korean companies that built their growth models around Chinese demand are now scrambling to find new markets that don't exist. Signal 3, the debt bomb. South Korean household debt hit 105% of GDP in 2025, one of the highest rates in the developed world. We're talking about $9 trillion in household debt for a country of 52 million people. Korean families binged on real estate during the pandemic, taking out massive mortgages assuming property values would keep rising. Now property prices are falling. Interest rates, despite the recent cut, are still elevated. Debt service costs are crushing household budgets. When households are this leveraged, they can't spend. Consumption dies, the domestic economy contracts, and South Korea's domestic consumption was already weak compared to export-driven growth. Signal 4, currency crisis risk. The Korean won has lost 11% against the dollar since October 2025. That might not sound dramatic, but for a country that imports oil, natural gas, and raw materials, it's devastating. Every one that falls makes imports more expensive. Energy costs spike. Manufacturing input costs rise. Inflation gets embedded in the system. And the central bank faces an impossible choice: raise rates to support the currency and kill the economy, or cut rates to help growth and watch the one collapse further. They just chose option 2, which tells you how scared they are about growth. Signal 5, export order drought. South Korea's export orders for future delivery, the forward-looking indicator, fell off a cliff in late 2025. We're talking about a 16% decline in new orders. This means companies around the world aren't just buying less Korean stuff now, they're not even planning to buy it in the next 6 months. The pipeline is empty. This is the indicator that predicted every major slowdown. When future orders collapse, layoffs and production cuts are coming, guaranteed. So why does this matter beyond South Korea? Because the global economy is one giant interconnected machine, and South Korea is a critical gear. Let's trace the dominoes. South Korean chip manufacturers cut production because orders are down. This means less demand for chip-making equipment from Dutch, Japanese, and American companies. ASML, Tokyo Electron, Applied Materials, they all take hits. Their stock prices fall, they cut jobs. They reduce capital spending. South Korean shipbuilders cancel orders for steel. This hits Australian iron ore exports and Brazilian steel producers. Commodity prices drop. Resource-based economies from Australia to Canada to Chile see revenue collapse. South Korean consumers, crushed by debt and falling asset prices, stop buying. This kills imports from everywhere. Less German cars, less American beef, less Japanese electronics, less Chinese consumer goods. South Korean banks, exposed to bad real estate loans, start tightening lending. This creates credit crunch conditions that spread through Asia. Companies can't borrow to invest or even maintain operations. Growth stalls across the region. And here's the scary part. South Korea is actually in relatively good shape compared to some of their neighbors. Japan is dealing with the same issues. Taiwan's export-dependent economy is seeing similar warning signs. Singapore's trade indicators are terrible. If South Korea is the canary, the rest of Asia is the coal mine. And when Asia goes into recession, it takes the world with it. Asia is 40% of global GDP. You can't have Asian recession and global growth. It's mathematically impossible. The US tech sector depends on Asian demand and Asian supply chains. European manufacturers depend on Asian consumers. Latin American commodity exporters depend on Asian industrial demand. The connections run everywhere. And let me give you a specific example that should terrify you. Samsung and SK Hynix supply the memory chips that go into NVIDIA's AI accelerators. If Korean chip production falls, NVIDIA's supply chain gets disrupted. If NVIDIA's growth story wobbles, the entire US tech rally that's been holding up markets collapses. One country, one industry, global consequences. Now, South Korea has been through crises before. The 1997 Asian financial crisis nearly bankrupted them. The 2008 collapse hit them hard. But they always bounced back, usually pretty quickly. So what makes this time different? First, the global context is worse. In 1997 and 2008 and could pull Asia out of recession. Today, China is part of the problem, not the solution. Their economy is struggling with structural issues that won't be fixed quickly. Second, the policy tools are weaker. In past crises, South Korea could slash interest rates to stimulate growth. They cut from 5% to near zero in 2008 and it worked. But they're starting from a lower base now, with less room to cut, and inflation is still a concern. Third, the debt levels are unprecedented. In previous crises, South Korean households weren't this leveraged. They could spend their way through downturns. Now they're trapped by debt service. The usual fiscal stimulus doesn't work when everyone's paying down mortgages. Fourth, the geopolitical tensions are higher. South Korea sits between China and Japan, both economically and militarily. US-China tensions put them in an impossible position. Any serious recession could trigger political instability that makes economic recovery harder. Fifth, and this is the big one, the global economy is more fragile than at any point in the last 40 years. Government debt levels worldwide are at peacetime records. Central banks have limited ammunition. Trade tensions are high. The room for policy error is tiny. South Korea's crisis is hitting at the absolute worst possible moment. So what happens next? Let me walk you through the most likely timeline for 2026. First quarter 2026, which we're in now. South Korea's recession deepens. Unemployment rises from 3% toward 5%. More emergency policy measures get announced. The won continues weakening. Asset prices, especially real estate, keep falling. Second quarter 2026. The crisis spreads visibly to other Asian economies. Singapore, Taiwan, and Hong Kong all report negative growth. Japan slides back into recession. China's struggles intensify as Asian demand for Chinese exports collapses. Asian stock markets enter bear territory. The NC Asia index falls 25% from recent highs. Capital starts flowing out of the region toward perceived safe havens like US Treasuries and the dollar. Third quarter 2026. The contagion reaches Europe and North America. European manufacturers report sharply lower earnings due to collapsed Asian demand. US tech companies miss revenue projections. Corporate profit forecasts get slashed worldwide. Global trade volumes contract at the fastest pace since 2020. Shipping rates collapse. Commodity prices from oil, copper to steel all fall sharply. Fourth quarter 2026. The Federal Reserve and other central banks are forced to cut interest rates aggressively as recession becomes undeniable. But the cuts come too late to prevent significant job losses. Unemployment in major economies rises from current near record lows towards 6 to 7%. Consumer spending drops. Housing markets weaken globally. Stock markets have their worst year since 2008. Now, this is the negative scenario, but it's the one that South Korea's indicators are pointing toward. Could it be avoided? Theoretically, yes. Massive coordinated global stimulus could work. Emergency trade agreements could help. Aggressive monetary easing everywhere might cushion the blow. But coordination requires political will that doesn't currently exist. The US is dealing with its own fiscal issues. Europe is fragmented. China is ideologically opposed to the kind of stimulus that would be needed. Which means we're probably going to let this play out the hard way. Alright, so what does all this mean for your life and your money? If you work in tech, manufacturing, or any export-related industry, understand that layoffs are coming. Companies will blame AI or restructuring, but the real driver will be collapsing global demand. Update your resume. Build your network. Consider your plan B now. Not when the pink slips start flying. If you're invested in stocks, especially tech stocks, the current valuation's price in continued growth, that's not going to materialize. You don't have to sell everything and hide in cash, but rebalancing toward defensive sectors, consumer staples, utilities, healthcare makes sense. Reduce exposure to semiconductors, industrials, and discretionary consumer goods. If you own real estate in markets that boomed during the pandemic, understand that a global recession will put downward pressure on property values everywhere. It might be wise to lock in equity now, if you were planning to move anyway. If you have significant dollar-denominated debt at variable rates, and rate cuts are coming, you're actually in decent shape. But if you have exposure to other currencies or variable rate debt in vulnerable markets, consider refinancing to fixed rates while you can. For everyone, build your emergency fund. The standard advice is 3 to 6 months of expenses. In this environment, I'd aim for 6 to 12 months. When recession hits, credit gets tight, and having cash reserves becomes crucial. And pay attention to policy responses. If governments start announcing major stimulus programs, that could change the trajectory. If central banks coordinate aggressive easing, that could cushion the blow. The outcome isn't predetermined. It depends on how policymakers respond. But the warning signs are clear. South Korea is telling us something important. The question is whether we're listening. South Korea's economy might seem distant and irrelevant to your daily life. But the interconnected global system doesn't work that way anymore. When the canary stops singing, you don't debate whether the air's really toxic. You get out of the mine. The export collapse, the currency crisis, the debt burden, the chip cycle downturn, the China exposure. These aren't random data points. They're chapters in a story we've seen before, and the ending is never pretty. 2026 is shaping up to be the year the bill comes due for a decade of cheap money, excessive leverage, and unsustainable growth models. South Korea is just the first to get the invoice. If this opened your eyes to something the mainstream isn't covering yet, share this video. Subscribe because I'll be tracking how this unfolds month by month, and whether the dominoes actually fall or somehow stay standing. Knowledge is your only real protection in what's coming. Your move.